But with a 1.5% slide in the S&P 500 Thursday, wiping out the benchmark's advance for October, halting a streak of monthly gains that would have been the longest since 2021, what can we expect in November ahead of the election and the Fed's next meeting? Joining us for more, we've got Rob Haworth, who is the U.S. Bank Wealth Management Senior Investment Strategist here. Rob, good to have you on Yahoo Finance here with us this morning. So what is the setup now that we're kicking off November and you've got a major event, of course, two major events taking place in the same week in the election and then also, of course, the Fed's next meeting where we'll hear a little bit more about their pathway forward coming off of that massive 50 basis point cut that we saw in September?
Yeah, it's been a busy 2 weeks, and we're going to strap in for next week as well. It's going to be very busy for us with those two events, especially in the wake of the news we got today and last week, right? A lot of uncertainty really about the labor market at this point because of the weather-related data. So we're thinking more volatility next week, particularly as the election goes, because it's probably, given how close this is, it's unlikely we get a result Tuesday night. That may extend for some time. The Fed meeting is Thursday instead of Wednesday. We'll have to see what the Fed does. The market now thinks the Fed's definitely cutting a quarter of a point, and maybe will go a half. That seems unlikely. They'll probably cut by just a quarter and set themselves up for maybe another cut in December, depending upon how the economic data continues to unfold, especially as we get through the weather and strike-related data. So we're kind of bracing for more market volatility as we look ahead. We're staying neutral in our portfolios, looking for those opportunities to arise because we think they very well could, right? Because underlying that all, we've got between this week and next, 54% of the S&P 500 reports earnings. So a lot of data coming our way that we really need to ingest. Probably means more volatility, but also more opportunity for investors as we look ahead.
So, Rob, should investors then be looking at any sort of pullback then as a buy the dip opportunity?
We think so, and really the reason is we're looking at earnings expectations as still constructive. We're looking at 240 really for the rest of 2024. We'll have to see how that pans out, but expectations are really pretty robust still for 2025. Around 274 on the S&P 500 is where consensus is coming in. That's maybe a little elevated. That could come down a little bit in our view, but that's still pointing to double-digit earnings growth in 2025, which is very constructive for this market as we look ahead. Even at these high multiples, that growth story still looks fairly positive.
What do you think the catalyst is for that growth story?
Well, frankly, one, the Federal Reserve is cutting rates, and that will help this economy and the earnings story. Two, even with the soft hiring data, that unemployment rate at 4.1% is still quite low. So we're still an economy with people at work, people earning incomes, right? We had good average hourly earnings growth. So that's going to drive consumer spending even into next year. We've seen very solid GDP prints for all of this year. It may soften a little bit into next year, but that's still enough to keep corporate earnings moving ahead. And lastly, we've got this investment cycle that's still happening, maybe a little slower based on the earnings result we saw this week, maybe a little slower in terms of artificial intelligence spending, but we still have this earnings cycle, this investment cycle moving ahead, which will be supportive into next year. So the story, the backdrop, there are certainly risks, but the backdrop for this is very solid.
All right, Rob Haworth, great to get your insight here this morning. U.S. Bank Wealth Management, thanks so much for joining us.
Thank you.